Hello friends, welcome to my channel Risk Management Research. I would request you to subscribe to my channel and I shall be bringing things about not only risk management but the background of it and the research element on that. Today I am going to discuss my own particular experience that I used to do as a kid when I used to play, and I was not knowing that the thing that I was using has got a scientific technique in that. So sometimes children use certain things which even not known to them, but that has got an element of scientific element, and that's where one can play and learn. So I have given the topic of six marvels and risk-based research. Why six marbles? Because marbles, as you can see that the kids are playing with the marbles, and risk-based capital is a is a method which is being used to set aside the capital in the insurance companies and the bank in the current regime. So I'm going to explain how does the thing that I used to do has got a context in the present sense. Let's move on. So as I said that sometimes kids unknowingly use playing technique that have a foundation of scientific approach. A similar thing happened to me during my younger days while playing marbles. This concept of modern day risk based capital regime technique used in banks and the insurance company. I've just described the same thing in the previous slide, and that's the explanation I'm going to give in this particular talk. Um, what I understand, through my experience as well, that we humans are inherent risk managers. We human takes various different measures to manage and mitigate our own risks, and in that aspect we even don't realize that we are the risk managers. So what used to happen? What is the story behind it? As a kid, during 1970s, when I was around 10 years, 10ish, I would say, in around in 70s. So I used to play marbles every day after coming from the school, and I had made a very simple rule that I shall take every day only six marbles in my pocket. So I had a bucket full of marbles with me, and I carefully used to choose six marbles and used to put in my pocket and go to play with my friends. My logic was simple that if I lose my marbles, then my maximum loss on any particular day will be the six marbles. Because my another sense was that I will not come back to home to pick the another set of marbles. And that was my logic, of taking the six marbles. That is to maximizing my loss to the six marbles. On the other hand, my friends used to come with a pocket full of marbles. Some, coming with the 10, 20, and others used to, purchase on a daily basis. Uh, Quite fortunately, I was good in playing the marble, and my winning percentage was very high. Close to 90-95% was my winning percentage. Um while maximizing, so in that case, while I was winning most of the time, my maximum loss was the maximum of the six marble. What happened that through this I collected the box full of marbles. So what I realized that behind every concept, this is a concept as a child developed within my mind, that let's minimize my loss. So as a science, the concept is first developed within the mind, and then it goes into the books. So that's the one thing that I'm realizing now. Now let's convert this into into the financial risk management terms. Now assume that a box full of marble as a shareholder's money. So the box full of marble that I have it. Assume that it is a shareholder's money, which which is doing a business in, say, insurance company or bank. And let's say that one marble is equal to 1 million US dollar. So in financial terms, if an insurance company or a bank keep $6 million every day, if the insurance company or a bank keep aside $6 million every day, then there is a 95% chance that they will remain solvent. So that's that how it is translated into the financial terms. So the $6 million, which is the amount which has come, is what is called the risk-based capital. So capital is a money that is used by the banks and the insurance company uh, to maintain the solvency of the company, and it is being used to protect that the company don't become insolvent. So this is the maximum loss any financial institution can suffer and survive. So the concept that I am saying, that turning same thing into the risk-based capital regime, that $6 million. So let's not get into the number of the $6 million. I've just converted my simple six marbles into the $6 million. In reality, this number could be a different number. A concept used in a bank and an insurance company to keep aside the solvency capital. Actually, this concept is coming from the value at risk in the statistical terms. If we look at the value at risk definition, then what it says is that it is the maximum amount of loss at a certain level of confidence percentage. That is x, it is how much the loss, maximum loss, and financial institution can suffer, given that there is a 99% of the safety. In another term, I would say that the capital and the risk become the synonymous. Now here I come back to the convergence between the marbles and the risk management. So here, in my particular case, six marbles for every day was my personal choice. There was no science behind that, why six marbles? Why not seven? Why not eight? Or why not 10? It was just my personal choice. It was, just in my mind that six is a number. However, in statistics, the maximum loss is calculated as a dollar amount based on the level of certainty and financial institution want to have, such as 99%. And that's what the concept of value at risk is. So when and the financial institution will calculate, their number will come out to be something different than the six. I was lucky that six marbles gave me the 95% winning probability. Now here comes the another scenario. As a simulation, if I could have lost many games, right, I might have needed to increase the number of marbles from 6 to 7, 8, or even more, because my winning percentage was very high. of close to 95%. Therefore my sixth number was was good enough. Had I been losing more number of games, then I had to increase from 6 to 7 or to 8. And that's what, again, the concept of the risk comes, that you have to increase, because your winning percentage. Similarly, in the financial institutions, if the risk increases, then they have to increase the capital amount. In this case, I had the loss maximum loss bearing capacity, or it can be said, that my risk appetite was the six marbles. So it can be seen that how does a simple concept of a child who plays a marble converges into the modern day risk management, the concepts. That's what I wanted to share with you. This the simple playing concept that I used to use with with the science behind that. That's where the conversion of games into the science. So you can comment on it, and you can share your views, that what do you think about it. And also, as a child, you can observe that the what does the other childs are doing. There could be the another thing that the childs are using, and that could have the another scientific element, because our brains are tuned to that. Our brain is a very very scientific in nature. All the things that have been written in the books have come first in the brain, and then it has got into the books. I think we all need to remember this. Therefore, first it need to happen, and then it goes to the books. So for now, thank you for listening. And do subscribe if you like. If you have liked it, you can like it. If if you want, you can share it with the other people. And yeah, keep on watching. I will keep on sharing my videos in the future. Thank you, and thanks a lot.